The terms bull market and bear market are frequently used in the world of investing, but they can often seem confusing to newcomers. Understanding these market conditions is essential for anyone involved in trading or investing, as they directly influence strategies, decision-making, and potential returns. In simple terms, a bull market refers to a period of rising prices, while a bear market is a period characterized by falling prices. However, the differences between these two market conditions go much deeper than just price trends. In this video, we'll break down the key distinctions between a bull market and a bear market, providing a comprehensive yet easy-to-understand explanation. 1. Market trend direction. Up versus down. The most fundamental difference between a bull and a bear market is the direction of the market trend. A bull market is characterized by rising prices across various sectors, creating a general sense of optimism. Investors are confident that prices will continue to increase, leading to more buying and higher prices. On the other hand, a bear market is marked by falling prices, where investors fear that prices will continue to decrease. As a result, selling activity increases, and the market sees a downward trend. In a bull market, the prevailing sentiment is positive, whereas, in a bear market, the sentiment is negative. 2. Investor sentiment. Optimism versus pessimism. In a bull market, investors are generally optimistic and confident in the future. They believe that economic conditions are favorable, and there is a sense of enthusiasm about the growth prospects of companies, industries, and the economy as a whole. This optimism drives investment decisions and contributes to a self-fulfilling cycle of rising prices. Conversely, in a bear market, the sentiment is more pessimistic. Investors fear further declines and are hesitant to make new investments. This pessimism leads to a loss of confidence, causing many investors to sell off assets and take a more defensive approach. The prevailing sentiment in each market is one of the most significant emotional drivers behind market movements. 3. Market activity. Increased buying versus increased selling. During a bull market, buying activity dominates the market as investors rush to capitalize on rising prices. Investors, both retail and institutional, are eager to enter positions, expecting further price gains. The increased demand for stocks or other assets pushes prices up, creating a feedback loop of continued buying. In contrast, a bear market is characterized by increased selling activity. As prices begin to fall, more investors attempt to cut their losses, selling off their holdings to avoid further declines. This mass selling contributes to a downward spiral, exacerbating the price drop and making the market even more bearish. 4. Duration. Long-term versus short-term. Bull markets tend to last much longer than bear markets. A bull market can last several years, with gradual price increases that continue over time. The optimism and positive sentiment that drive a bull market can fuel its longevity, as investors continue to buy and the economy grows. In contrast, bear markets are typically shorter-lived but more intense. While some bear markets can last for years, many are short, sharp corrections driven by specific economic or financial events. For instance, the global financial crisis of 2008 saw a relatively brief but severe bear market, which lasted less than 2 years. Bear markets can be unpredictable in terms of duration, often lasting until a major market correction or external event triggers a turnaround. 5. Economic indicators. Strong growth versus economic contraction. The underlying economic conditions of a market can provide significant insights into whether it is a bull or bear market. Bull markets are usually accompanied by strong economic growth, low unemployment, rising corporate profits, and high consumer confidence. These favorable economic indicators reinforce investor optimism and contribute to the overall upward momentum in the market. On the other hand, bear markets often correlate with economic contraction. When the economy is shrinking or struggling, businesses may face lower profits, and unemployment may rise, creating a challenging environment for investors. In a bear market, the economy is often in a recession or facing other challenges that contribute to negative market sentiment. 6. Risk appetite. High versus low. Investor risk appetite is another key differentiator between bull and bear markets. In a bull market, investors are more willing to take on higher risks, as the overall market trend is upward, and they expect higher returns. As stocks and other assets rise in value, investors are more likely to invest in riskier assets, such as growth stocks, emerging markets, or even speculative investments. During a bear market, however, investor risk appetite significantly decreases. With falling prices and the potential for further declines, investors prefer safer, more stable investments, such as bonds or defensive stocks. The fear of losing money during a bear market leads to a general aversion to risk. 7. Volatility. Moderate versus extreme. While both bull and bear markets can experience volatility, the nature of the volatility differs between the two. Bull markets typically have moderate volatility. While prices may fluctuate in the short term, the long-term trend remains upward, and investors feel secure in their investments. Volatility in a bull market is often seen as a temporary market correction that does not deter long-term investors. In contrast, bear markets tend to have extreme volatility. As prices fall sharply, panic sets in, and investors react impulsively. This can lead to sharp declines in asset prices, sudden swings in the market, and heightened uncertainty. The fear of further declines often exacerbates volatility in a bear market. 8. Market liquidity. High versus low. Market liquidity refers to how easily assets can be bought or sold without causing significant price fluctuations. In a bull market, market liquidity is generally high. Investors are eager to buy, and there is a steady demand for assets. This allows for smoother transactions and less price impact when buying or selling. In a bear market, liquidity can dry up as more investors seek to sell their assets. The reluctance to buy and the fear of falling prices reduce the overall demand for assets, making it more difficult to liquidate positions without incurring significant losses. The lack of liquidity can make it harder for investors to exit their positions during a bear market. 9. Investment strategies. Growth versus defensive. During a bull market, investors focus on growth-oriented strategies. The general belief is that asset prices will continue to rise, so they look for investments that have the potential for rapid growth. This includes stocks of companies with high potential, tech startups, or sectors poised for expansion. Investors often buy into companies with high price-to-earnings ratios, expecting future growth to justify current prices. In a bear market, however, defensive strategies dominate. Investors seek to protect their capital by shifting towards safer, more stable investments, such as dividend-paying stocks, bonds, or precious metals like gold. These investments are perceived as less likely to lose value during a downturn and provide steady returns despite falling prices in other areas of the market. 10. Recovery. Gradual versus sharp rebounds. The recovery process differs significantly between bull and bear markets. Bull markets tend to have a gradual recovery, as prices rise steadily over time, supported by sustained investor confidence and economic growth. In these markets, corrections are often brief and don't derail the long-term upward trend. However, recoveries from bear markets can be sharp and unpredictable. After a significant market downturn, bear markets can see dramatic rebounds, often triggered by major changes in economic policy, corporate earnings, or investor sentiment. These sharp recoveries can happen quickly, but the underlying uncertainty and risk remain until the market fully stabilizes. The distinction between bull and bear markets is crucial for anyone looking to understand financial markets and investing. While bull markets are characterized by rising prices, optimism, and growth, bear markets reflect the opposite: falling prices, pessimism, and economic contraction. Recognizing these key differences can help investors make informed decisions about when to invest, when to hold, and when to protect their portfolios. Understanding market sentiment, the direction of prices, and key economic indicators allows investors to navigate both market conditions with greater confidence. By learning how to recognize the signs of both bull and bear markets, investors can better position themselves to take advantage of opportunities and minimize risk in their financial journeys.